One of the most powerful wealth-building strategies is compounding, where your money grows over time as earnings generate even more earnings. The earlier you start, the greater your potential returns. Investing in compounding assets can help you achieve long-term financial stability and even financial freedom. The secret behind compounding is simple. Your money starts making money, and that money makes even more money. The longer you let it grow, the bigger the results. But not all investments compound at the same rate. Some grow aggressively, while others provide steady, predictable returns. The key is to diversify into different compounding assets that align with your financial goals. In this video, we will break down the 9 best compounding assets you should start investing in today. Subscribe to Finance Family for smart financial insights. 1. Stocks. Ownership in growing companies. Investing in stocks means buying shares of a company, making you a part owner. As the company grows and earns profits, your stock value increases. Why it compounds. Stocks generate returns through capital appreciation, rising share prices, and dividends, profit sharing. If you reinvest dividends, your investment compounds even faster. Best approach. Invest in blue-chip stocks, e.g., Apple, Microsoft, and use dividend reinvestment plans, DRIPs, to maximize compounding. Example. If you invest $1,000 in a stock that grows at 10% annually, in 20 years, it becomes $6,727 without adding extra money. To get the most out of stocks, it's important to stay invested long-term and avoid panic selling during market dips. Many successful investors follow a buy-and-hold strategy, letting their investments grow over decades. Another factor that increases stock compounding is time in the market, rather than trying to time the market. Many people make the mistake of buying and selling based on short-term trends. However, those who remain patient and reinvest their dividends see significantly higher returns over the years. 2. Index funds. Low risk, high reward growth. Index funds track major stock market indexes like the S&P 500, providing diversification and steady long-term growth. Why it compounds? The stock market has historically returned 8 to 10% annually. Index funds grow over time as the economy expands. Best approach? Invest in low-cost index funds, e.g., VOO, VTI, and reinvest dividends. Example. A $500 monthly investment in an index fund at 10% annual return grows to $1.1 million in 30 years. A major advantage of index funds is their low maintenance and lower risk compared to picking individual stocks. They are great for investors who prefer a hands-off, long-term strategy that benefits from compounding over time. Since index funds hold hundreds of stocks, they provide diversification, reducing risk. Unlike individual stocks, which may crash, a well-diversified index fund historically bounces back after market downturns, making it one of the safest ways to invest for long-term growth. 3. Real estate. Passive income and appreciation. Owning rental properties is a great way to earn passive income while benefiting from property value appreciation. Why it compounds. Rental income covers the mortgage while property values increase over time. Best approach. Buy properties in high-growth areas and leverage bank loans to maximize returns. Example. A $300,000 house appreciating at 5% annually will be worth $800,000 in 30 years, plus rental income along the way. One of the biggest advantages of real estate is leverage, using a bank loan to purchase property. This allows investors to control a high-value asset with a small down payment, multiplying the effects of compounding growth. Additionally, rental properties generate a steady income stream, which can be reinvested into additional real estate or other compounding assets, accelerating overall wealth accumulation. Over time, as the mortgage is paid off, cash flow increases, providing even greater financial security. Another advantage is tax benefits, including deductions for mortgage interest, property depreciation, and maintenance costs, which enhance long-term returns. 4. Dividend stocks. Get paid. While you invest, dividend stocks pay you a portion of their profits regularly, allowing you to reinvest the earnings for compounding growth. Why it compounds. Reinvested dividends buy more shares, increasing future payouts. Best approach? Focus on dividend aristocrats, companies that have increased dividends for 25 plus years. Example: a $10,000 investment in a stock yielding 4% in dividends, compounded for 20 years, grows to $44,000. Dividend investing is especially useful for those looking to generate passive income while still benefiting from long-term growth. By reinvesting dividends, you can experience exponential gains over time. Some companies even offer dividend reinvestment plans, DRIPs, which automatically reinvest payouts into additional shares, boosting compounding effects without requiring active management. Long-term investors who focus on high dividend yield stocks and reinvest their payouts can see their investment snowball into a significant income-generating asset. Over decades, this can even replace a traditional salary, providing financial independence. 5. Bonds. Stable growth with interest. Bonds provide fixed interest payments over time, making them a lower-risk compounding asset. Why it compounds? Interest payments can be reinvested to generate more interest. Best approach: invest in government and corporate bonds for steady returns. Example: a $5,000 investment in a bond with a 5% return, compounded annually, becomes $13,266 in 20 years. Bonds are an excellent choice for risk-averse investors who prefer predictable, stable returns. While they don't grow as aggressively as stocks, their steady compounding effect can provide financial security over time. A well-balanced investment portfolio often includes a mix of stocks, bonds, and other compounding assets, allowing investors to balance growth potential with stability while maximizing overall returns. Investors nearing retirement often shift a portion of their portfolio into bonds to preserve capital while still benefiting from compounding. Since bonds are less volatile than stocks, they provide financial stability and predictable returns, which is ideal for those who want a low-risk, income-generating asset. Even though bonds might not offer the highest returns, they serve as an essential part of a diversified investment strategy, ensuring that growth continues even during economic downturns. 6th, REITs, real estate investing without buying property. Real estate investment trusts, REITs, allow you to invest in real estate without owning physical property. These companies own and manage income-generating real estate, such as apartments, office buildings, and shopping centers. Why it compounds? REITs pay out at least 90% of their profits as dividends, which can be reinvested for compounding growth. Best approach: invest in dividend-paying REITs and reinvest earnings to maximize returns. Example: a $10,000 investment in a REIT with a 7% annual return, compounded over 20 years, can grow to $38,697. REITs provide a great way to diversify your investments without the headaches of managing properties yourself. Plus, since many REITs pay out monthly or quarterly dividends, they create a steady stream of passive income while still offering long-term growth. Unlike rental properties, REITs are highly liquid, meaning you can buy and sell them easily, just like stocks. This makes them a low-barrier entry into real estate investing with the added benefit of compounding through reinvested dividends. 7. High-yield savings accounts, low-risk compounding. A high-yield savings account, HYSA, is one of the safest compounding assets, providing consistent, low-risk returns. While it won't make you rich, it ensures that your money grows steadily over time. Why it compounds? Interest is automatically added to your balance, generating more interest in the future. Best approach: choose an HYSA with high interest rates, 3 to 5%, and no fees. Example: a $5,000 deposit in a 4% HYSA, compounded monthly for 10 years, grows to $7,407. HYSAs are perfect for emergency funds or short-term savings, while still taking advantage of compounding. Unlike riskier investments, your money is safe from market fluctuations and remains easily accessible. Some online banks offer better interest rates than traditional banks, making them a better choice for maximizing growth. Always check for FDIC insurance to ensure your deposits are protected. 8. Certificates of deposit, CDs. Safe, fixed returns. Certificates of deposit, CDs, are low-risk, time-based investments where your money earns interest at a fixed rate over a set period. Why it compounds? Interest rates are higher than standard savings accounts, and earnings are reinvested. Best approach? Choose longer-term CDs, 3 to 5 years, with the highest rates. Example: a $10,000 investment in a 5-year CD at 5%, compounded annually, grows to $12,762. CDs are ideal for risk-averse investors who want predictable returns without market volatility. They work best when laddered, meaning you invest in multiple CDs with different maturity dates, ensuring continuous growth and access to funds. While CDs offer lower returns compared to stocks, they still provide a safe and steady compounding effect over time. 9. Cryptocurrency: high risk, high reward growth. Cryptocurrency, like Bitcoin and Ethereum, has gained massive popularity due to its explosive growth potential. While highly volatile, some crypto investments offer compounding returns through staking and yield farming. Why it compounds? Many cryptocurrencies offer staking rewards, where you earn interest on your holdings. Best approach: invest in established cryptocurrencies and stake them for passive growth. Example: a $1,000 investment in a crypto staking platform offering 8% annual returns can grow to $4,660 in 20 years if compounded. Unlike traditional assets, crypto operates on blockchain technology, making it a decentralized and innovative investment. While highly speculative, many investors see crypto as a long-term wealth-building opportunity. To reduce risk, consider diversifying with stablecoins, which offer staking rewards without extreme volatility. Always do thorough research before investing, as crypto markets can be unpredictable. Final thoughts: investing in compounding assets is one of the smartest ways to build long-term wealth. Whether you choose stocks, real estate, bonds, or crypto, the key is to start early and stay consistent. The power of compounding works best when you let your money grow over decades, allowing earnings to multiply on their own. Even small investments today can turn into life-changing wealth in the future. If you found this video helpful, don't forget to like, share, and comment below.